Most people think wealth comes from working harder. It actually doesn't. It comes from positioning capital where it works harder than you do. The problem is most investors are still playing the wrong game. They chase trends, they follow the noise, they invest without a clear framework, and they call it strategy. It's not. Passive investing isn't about being passive, it's about being precise, knowing what to look for, what to avoid, and when to act. Because in today's market, returns don't come from luck. They come from disciplined decisions, strong operators, and understanding the risks before you ever wire capital. That's exactly why we're bringing together investors who have been through multiple cycles, not to pitch deals, not to raise capital, but to break down how this actually works, what matters most, and what doesn't matter, and how to think differently than most investors. Who's building long-term wealth, not chasing short-term wins? If you're serious about putting your capital to work the right way, this is where it starts. This conversation. Smart Money Moves unlocks the next wealth wave of passive investing. So join us for the conversation. Buddy, welcome. Glad that you are here. We're going to give a minute or so here for some people to log on. I know that there's always that lag from people, sitting in the waiting room until they get in here. And we had a bunch of people register, so I'm sure we're going to have some latecomers. I want to welcome everybody tonight. Super excited about this panel and super excited about, some of the questions I have, and where this will go tonight. I love these webinars and these panel webinars especially because you just never know where the conversation's going to go. I have a list of questions, and I think that we sent the panelists all those questions that we were thinking about using. And just so the panelists know, I threw that whole list out and started all over again. So you guys are out in the dark today. So welcome everybody though. So I'm Mike Morawski, and I am hosting these great experts in the capital raising space. So whether you're joining us today as a passive investor, looking to place capital more intentionally this year, or someone who's looking to learn how to raise capital and build meaningful relationships in this space, you're exactly in the right room. I know you won't be disappointed. We are not here to sell you anything today. We're here to totally bring you some education about the market, about what's going on in the market, where the market is headed, and how these great experts conduct business the way that they do. With the market shifting quickly again, now is the time to position your investment for tomorrow. A lot of people are sitting on the sidelines saying, hey, I'm just going to wait. I'm not ready to get started yet. I'm going to wait. And I always say, if you wait until the media tells you that the market has changed, you're already missed 18 or 24 months of this market change. I've said for 3 decades, and I've been in this business over 30 years, and I've said for 3 decades, if I could just get in just before the market changes and have the wind at my back, and that's the position that you're in today. So if you're a passive investor, you're in the right place. If you're somebody learning here to try and learn some tips and techniques, you're in the right place for that. We're really living in a time where the traditional paths to building wealth, like stocks, savings accounts, bonds, even single-family real estate, are being challenged more and more. Investors are turning toward alternative investments, and specifically multifamily real estate. Multifamily was the golden child for a number of years, cooled off, and I believe, my personal opinion, and we're going to see what these guys say tonight, my personal opinion is that this market is going to skyrocket again, and if you're in position, you're going to do well. But what investors are looking for today is they're looking for cash flow, and they're looking for tax advantages, those savings that you can get from alternative investments in real estate. And they're also looking for that long-term wealth creation and really everybody's looking, how do I preserve my capital? And I think we're going to talk about assets tonight and asset classes that do all four of those things. Here's the truth, though. Great deals don't get done without great capital. So we need you in order to do great deals. And great capital doesn't come without trust, relationships, and communication. So tonight, I hope that we have the opportunity to build trust, relationships, and communication with you, because that's what tonight is about. Today, we're going to go beyond just surface level conversations. We're going to dive into what really is happening. We're going to talk about building trust with investors, new investors. We're going to communicate effectively before, during, and after the deal, or how that happens. We're going to talk about scaling your capital raising business and develop the mindset required to operate at a higher level in this space. And to do that, I brought together 4 experts who are actively doing this at a very high level. I'm joined tonight and really honored for these 4 individuals to join me. But Michael Guthrie, Blair Dixon, Clint Harris, and Matthew Tufke. And when we get started here in a minute, I'm going to have them each introduce themselves. Each of them brings a unique perspective from building investor databases and raising millions in capital to structuring deals, nurturing relationships, and scaling their platform. These aren't just great thoughts or theories. These are teaching ideas from people who are actually doing and working deals with investors and navigating the same markets and the same conditions that we're all facing today. So my encouragement to you this evening is lean in. Take some notes. If you're driving, maybe pull over, pull your notepad out. And most importantly, think about how you can apply what you hear today, whether you're deploying capital or you're raising capital. Because at the end of the day, this business comes down to one thing: people, relationships, and trust. And if you can master those 3 things, you can win every day in this market and as we move forward. So let's jump in and get started. Hey, you know what? I always say ladies first. Blair, why don't you jump in and give a minute or so about who you are and what you do?
All right, sounds good. Thank you, Michael, for having me on this panel. Hi, everybody. My name is Blair Dixon. I am a realtor slash capital raiser in Southern California. So how do I get into this business? I graduated from Chapman University's business school about 5 years ago. Then I jumped into residential real estate head on and just starting to, doing residential deals. And what I realized, especially in the Southern California market, a lot of the investors, especially international investors, they are looking for an asset class that is easy to manage and give them a lot of, returns. So a lot of my clients actually lives overseas, but they trust in the U.S. Real estate market. But instead of owning single family rental property where they cannot physically manage while they're overseas, they are looking into different commercial projects. So before I joined force with Mike, I actually helped another company raise money for 2 UC Berkeley student housing. And it's kind of the similar concept where they acquire those rent down student housing and then do a renovation and rent it out, then eventually exit. I have a lot of success with that project. So that's why I am actively looking for more multifamily investment projects for my real estate clients, in addition to, like Mike said, their primary residence or stock market. So that's how I got into it. So yeah, thank you. And I'm so glad to be here to join the conversation with you guys.
Appreciate you being here tonight, Blair. Thank you. Hey, Matthew, why don't we jump over to you?
That sounds great. Hey, everybody, Matthew Typke. I am out of Austin, Texas. Started in real estate as a real estate agent as well. Really started, my mom was a single mom, raised my brother and myself, and she just started acquiring real estate when I was a little kid. And I was blessed to be able to see what's required and what that looked like. 16 years later, I own a real estate brokerage in Austin, Texas. My wife manages single family homes and pretty actively buying multifamily. Last year, bought about 800 doors. It was 2 apartment complexes. I just put a 400 unit under contract 2 days ago. and student of the game. I've always been very attracted to the Trammell Crow approach. For those that know him, old school real estate guy, very collaborative, willing to partner, willing to team up. And over the last few years, I have become a capital raiser, and it's been a grind. I've gone to probably 18 events in the last 18 months. I literally just left one yesterday. I'm at the airport now, and just constantly talking to people, trying to get involved, and blessed to be here and want to provide as much value and true insights as I can here.
Awesome. Thanks, Matthew. Appreciate it. And that's a big number, 400 units under contract now. So good for you. Good luck with that deal. Hey, Clint, why don't we jump over to you?
Thanks, Mike. I'm Clint Harris. Really excited to be here. Thank you for the invitation, Mike. Appreciate that. I'm one of the general partners with Nomad Capital. We're based out of Wilmington, North Carolina. My background has actually had a 16-year career working in cardiology, implanting pacemakers and defibrillators, working in the medical space and mostly in the EP lab, cath lab, and operating room. During that whole time, my girlfriend and fiance, now wife with two young boys, we were investing in real estate, single family, multifamily, Airbnbs. We still have 14 Airbnbs, and we built a property management company that manages another 75. And through that process, I got really burned out on active investment strategies, specifically in managing Airbnbs. It's probably one of the more active strategies out there. So that put me on the hunt for something that was a little bit more passive and had better opportunity to create the type of life that we were looking for with our children. And after asking a lot of people that were wiser than I am, my journey led me to self-storage, specifically self-storage conversions. And in 2020, I partnered with my partners, a father and son team that founded Nomad Capital. There's 4 of us general partners, and we started buying old Kmart buildings, grocery stores, warehouses, and textile mills and bottling facilities across the Southeast and converting them into climate controlled storage using our in-house GC team. We're currently sitting on a little over 120 million in assets under management. I raise the capital, my partners do the construction, build them out, and then we're fully vertically integrated. We raise the money from our private pool of investors, do the construction, and then do the property management in-house as well. So that's our story. We're continuing to roll. We have a couple projects under contract right now, and moving. It turns out to be self-storage for about half the cost of ground up development in about a third of the time. So it's working well in this current economy, but it's not the traditional multifamily guys that you're getting here on this panel. I'm sure these people have all raised significantly more capital than I have. Our raises are minuscule compared to multifamily. My last fund was $10 million for 4 facilities. We've done, I think, 11 facilities total so far.
Awesome. Thanks for being here, Clint. I appreciate you. Hey, Michael, how about jumping in, telling us about yourself?
What a panel you've curated here today. It's an amazing group. I started in the medical field as an X-ray / MRI tech, and then my wife and I got into placing and operating ATMs nationwide. We did that for the last 29 and a half years. Sold that business in May of 2023. During that time, we bought and owned 7 individual rental single-family homes, sold those off, got into the multifamily space. We currently own a little over 13,000 doors. I raised a little over $108 million in that space and the debt fund space in the last 4 years. So it's been a pretty quick rise in assets under management on that side. I'm helping manage a number of those in the deals. I'm a general partner in 14 of those opportunities, and like Clint was saying, I've started to take a little bit less of an active role. So I'm now just raising fund to fund in the limited partner side for a company that we're pretty much working with only one company because they're laser focused on just the multifamily area. So that's basically what I've been up to, and happy to help anybody in the space that's looking to learn how to raise capital, how to create relationships. And I think that's what we're here to talk about tonight.
Awesome. Thanks for being here. And I really appreciate you guys. And, we have a bunch of people online tonight. And I just want to mention that if anybody has any questions, the chat is operational. So feel free to put a question in there. We'll try and get it along the way here this evening. And also, if you want to just put hi in the chat so that we know you're alive out there and listening in and maybe where you're from. Hey, I want to start with this first question, you guys. But how do you define passive investing in today's market? And I think we're talking specifically about where we're at in today's market and where we're at in the market cycle. But how would you define passive investing for somebody who maybe doesn't know the difference? So, Clint, why don't we start with you?
So it's a little bit ironic you calling me first. I do co-host a podcast called Truly Passive Income. We're 160 episodes in right now, and I will tell you what I've learned from all of that and interviewing a lot of people a lot more intelligent than I am. It's tongue in cheek. There's no such thing as truly passive income, right? The reality is everything takes effort, even if that just means you're taking the time to establish a relationship, get to know someone that you know, like, and trust, and building a relationship up front. And then hopefully that's a partnership you can continue to invest in for 20 years. And that may feel passive and it may look passive, but the reality is you just front loaded the work. And hopefully a lot of times that work may look easier because you've put yourself in a position to make good decisions about people and their ethics and their communication. And I think the best decisions about who you invest with comes from knowing what your goals are and what you're trying to accomplish for your family. I think you can make those decisions quicker when you know where you're going and what you're trying to accomplish. But I think passive investing for me is something it's a buzzword. It's a marketing term. You'll see it all over social media and everywhere else. It's a lovely concept. The more you learn about it, the more elusive it becomes. And I think what you're really looking for is maybe not something that's necessarily passive. It's an outsized bet. You have to have three things to have success in real estate investing. It's time, it's experience, and money. Now, you don't have to have all of those, but you have to have a combination of those three. So what you're looking for is a situation where if you don't have time, it's really hard to get experience. But what you do have potentially is capital. And if you've got capital, you want to partner that with somebody else's time and experience. So because that's the most passive leg of that three-legged stool. You got to have time, experience, and money. And what you're looking for is someone with an asset class that leads into the goals that you're trying to accomplish for your family. You believe in their ethics, their communication, their background, their track record. And then you're providing the capital and you're leveraging their time and experience to execute. And then you make sure that you're sitting back, you're getting the monthly updates, the quarterly distributions, anything else it may be. At that point, it can be as passive as you want it to be. My recommendation is stay involved, continue to build those relationships. But at the end of the day, what you're trying to do is make sure that your capital is getting up and going to work even when you don't want to. A passive investment strategy to me is when you're making an investment that is buying future days off. And eventually that investment starts buying enough of them that you don't have to get up and go to work anymore because your capital has gotten up and gone and done that for you. But the reality is it's mostly not passive. If you make an investment one day and it looks passive, but it came from something that you learned from this esteemed panel or from Mike here, just realize that it's not passive. You just preloaded the work. You've taken advantage of the law of 100 hours with your commute in your car, that within 1 year of your drive time, you're going to know more than 95% of the population about a subject. You just become a student of the game, like Matt mentioned. That's the reality. It may look and it may feel passive, but the reality is it usually rides on the backs of the people you've met, the relationships you've built, and the time that you've invested into yourself. And at that point in time, the capital looks like a passive investment because you're leveraging other people's time and experience.
Awesome. Thanks, Clint. How about you, Matt?
Man, I said that was well said.
Right.
I like how he said the more you learn about it, the more elusive it is. That's a cool concept. Yeah, it's true. I mean, especially now, right now, you're kind of going against the grain in some sense of investing when the market's down. And so, like Clint's saying, it's actually better to be as active as you possibly can to find the right opportunities. And like you said, you front load it and you get passive later. But you got to just love this real estate space to do it, right? Even if, I mean, just to simplify, which most of us know this, but if you invest $1 million in a deal and you make a 6% return, it's 60 grand a year. That's amazing. but you're not going to retire on that, right? And most people don't have $1 million, right? Or it might take them 10 years to get that point to then get to the 60. So you got to just love the game and really plug in with the right people. And that's what Clint's talking about is the relationships are key. And it's there's a trade-off, right? Like I'm a active GP. My dream would be to totally be passive if that's even possible. However, I love the entrepreneurial path. So I would think of it more as what you said as in today's environment, you got to be counterintuitive. You got to go against the grain. And I wouldn't even personally, I was thinking about this as he was talking, consider it passive until you get your full investment back anyways, which is going to take a really long time. I mean, up until you get it back, it's not passive income. It's just return of your investment.
Yeah. I like what Clint said too, about that there is no really passive investing. And I tell all of our investors, hey, look, we're on an asset management call on your deal every week or every other week and, participate. They all have the calendar link. They can all jump on. They can listen to see what's going on. But I think as a passive investor, you learn a lot as well. Michael, how about you?
When I think of truly passive, and Clint hit it on the head, you find the right people to where you can place your capital in like a set it and forget it kind of a thing, but you're going to watch it, so it's not like completely forgetting about it. And that's like I live off right now. I completely live off of passive income that I'm not active in. My active stuff that I'm in multifamily right now is not creating the income I thought it would when we placed it, or that we were promised it could when we placed that capital. So now I'm in a lot of different debt funds where they're lending the money, because in most transactions there's a buyer, there's a seller, but the one true entity that always gets paid is the lender. So if you can get your money into a lending kind of fund, that's a great place to park it, because then that money's always churning an interest rate return. So I like to set it and forget it, but watch it, because you always have to be watching the people, and you have to have a certain level of know, like, and trust of that person or that company, the entity where you're placing the capital. So there's a way to do it. And like Matt was just saying, and I think Clint said the same thing. If you $1 million at a 6% return returns 60 grand, but 2 million returns 120, 3 180, or if it's returning a 10% return, it returns a little bit more. But a lot of people are looking to figure out, how do I take my passive or my money that I've already earned and turn it into income replacement? And I think that's what we all want, or we're all looking for in a truly passive environment. So figure it out. I'm going to drop a calculator in the chat that we use so somebody can actually figure out what truly passive income can do at the interest rate of return you're looking for.
Interesting.
Mike, can I add one note real quick, if you
Yeah,
don't
go
mind?
ahead, Matt.
I think it's very important, like, because the deals were people did these deals in 2020, 2021, and they went bad, right? The GPs did, and
Right.
it's very easy for LP investors to sit back and judge those people. And I'm not even in one of those deals, but I could have been, right? But my point of saying that is, you have just as much responsibility as the LP as the GPs do. It's not like the GPs were lying about the facts of the deal. And so people are sitting back saying these guys did all these bad deals, but the LP capital was enabling it, right? They made it so easy for people to raise money in 24 hours and 48 hours, and everybody was part of that problem. And so that's what I just want to touch on, that in the active passive sense of, like, you're participating in the market and the deals, like Clint said, in the front and front loading it. And so that's really important to know. Like, you got to go tour the property and look at the property and vet the operators. That's a whole process in and of itself. So I just wanted to add that in.
Yeah, no, I appreciate that. How
Can
about
I
you,
add
Blair?
one thing?
Yeah, go ahead.
Go ahead, Blair. Go ahead, and then I'll add back in.
Oh, okay. So me, the definition of passive from especially international clients lens is that do they have to be on call whenever there's an issue, or they can just get a report either monthly or quarterly? They can just review it. Obviously, just like your stock portfolio, you still have to talk with your financial advisor, maybe quarterly or annually to review it. The same with multifamily. It's just more of the time and the effort. Is that going to be more on call like a landlord, especially if you are not at the location where your property is located? Or are you able to, just do routine maintenance with the team on the ground and let them do the work while you are more of a supervisor kind of role? So that's my understanding of passive investment.
Yeah.
And
Yeah,
like what
great.
Matt was saying, that things were front loaded and people bought stuff in 21, 22, 23. I was buying stuff. I have a ton of money in things that were purchased at that exact time. And right now everybody's hanging on. But I'll guarantee you, no one on this panel, Mike included, with 30 years experience, me with a number of years experience in the space, nobody thought the interest rates would go up 2,100%
Yeah.
in 18 months.
Right.
And that's a true number. You can throw that into your chat GPT or your Claude and ask what the interest rate run up was between 21 and today. And in that short period of time, it was a 2,100% interest rate run up. Nobody underwrote to that specifications. And if you did, you shorted the market and you're sitting on a huge pile of dough.
Yeah, well, nobody ever sees that coming, right? You don't see that, which kind of, this some of the comments that have been made here really leads to my next questions, which is, what risks should investors be most aware of, and how can they mitigate them in today's market? Matt, why don't we start with you on that?
Well, I find it very interesting. So I'm in Austin, right? Austin had this crazy ramp up. And even at the time, people were making assumptions that it would keep going the same direction. Now, when you're able to buy these deals at 20, 30, 40% less, the challenge is you don't want to make those same assumptions again and go wrong, right? So that's the biggest challenge that I see is how do you make these deals pencil when you know it's at the time to buy? Like, our deal's going to go 50% lower. It's possible. Anything's possible. But now would be the time to invest. And it comes down to the LPs knowing as much as possible, right? Because, for example, myself, 16 years in, the knock that I get is, hey, I haven't ever gone full cycle. And I get it, right? But when am I going to go full cycle? It's going to be 10 years from now. So people do have to take a little bit of a gamble on me in a sense, but they got to know the asset, right? And what are the assumptions that are taking place? How is everybody making money? How much money are they putting in? And really check references in a big way. I mean, I've invested capital personally with people that I trust, and I have a lot of grace in knowing that like not everything's their fault, right? And so the more you can find people that will genuinely share where they're at, then I have deals that I'm in that they're struggling and they're not really like telling me they're struggling. I know they are, but if they would be open, I would be willing to get in the trenches with them and help in certain ways, right? And so you got to find people like that. I always say you want people that are going to be in your foxhole or that you want in their foxhole because that's what this is. Real estate is definitely about dollars, but in my opinion, if you wanted to write this down, what's more important than all that is people. And I learned that like 10 years in. Real estate's not about dollars, which sounds crazy. It's about people.
Yeah. Yeah, it's relationships, right? I mean, this is all a relationship business. It's just like bringing all you, the four of you together with me on this panel. We all have relationships with each other. So, hey, Blair, I know that you really you deal with investors domestically and some internationally. How would you address the risk issue? And would you address it differently with domestic investors or international investors?
Yeah, absolutely. So I'm bilingual, so I also speak Chinese. A lot of my clients are absolutely from China. Obviously, there are political uncertainties as well as tax laws. So I find the most important is just open communication. Give them all the information upfront. I even was involved with a law firm where they do the investment immigration, where international client can invest a significant amount of money in the US and create jobs and eventually get the permanent resident status. So with that experience, what I learned is never overpromise and underdeliver. Any type of investment, any type of legal process, there's always the risk of something goes wrong. You're never 100%. So it's the number one rule is always telling the client upfront, nothing is guaranteed. If you follow the procedure, if we keep an open communication, you will have a very high chance of being successful, whether whenever I was doing the legal immigration investment project or the UC Berkeley project. But at the end of the day, it's all about trust, and also based on their investment goals. Some people, they have higher investment tolerance than others. So, and also based on their portfolio, some people, they put 50% of their investment fund into one of those multifamily. Other people, it's only 5%. So just to getting to know them better, what's their goal, what's their risk tolerance, as well as disclose all the risk upfront, I find that to be very, very helpful.
Yeah, awesome. Great answer. Thank you. So, Michael and Clint, I'm going to go to you guys with this question. But what role does the market timing play in passive investing decisions? So, from an investor's standpoint, do you think that the passive investor really even realizes that or calculates that part of the risk? But what role does timing play in this? Whoever wants to go first, one.
Sure, I'll start. um, it certainly gets a lot more attention now than it did several years ago. I'm kind of blend this with your risk question a little bit because I think there's some symbiosis between the two. And the reality is we're talking more about risk because everybody has recency bias of what happened at the end of November 2022 when the rate shot up higher and faster than they ever had. I learned something, Michael. Thank you for the 2,100% in 18 months. All I knew it was a lot, and things obviously changed quickly. Warren Buffett says he's got a funny saying that says you can't tell who's skinny dipped until the tide rolls out. The reality is, I think the changes in the market that have created significant amounts of disruption for a lot of operators have also created opportunity. And one of the opportunities that I think is that a lot of operators have been seriously stress tested and vetted. And if you're operating now, a lot of people are a different breed. You really couldn't miss 5 years ago in multifamily. Everybody was making money hand over fist. Rents were going up and you just bought it. Here you increase the rents, the net operating income goes up, the value of the property goes up. And as long as rents continue to go up, that works. And as long as the taxes don't go up and the insurance doesn't go up and the debt doesn't go up, and as long as everything stays the same, then you're good, right? The reality is we've all been stress tested in a lot of different ways. And that risk profile is something that changes. And the timing of the market is extremely important in that regard. There's nobody has a crystal ball. You can't see what's coming down the pipeline. But I think that in terms of diversification, everybody always talks about diversifying across different asset classes, different geography, different operators. But there's a lot of different investors that had investments with different operators, different geography, and different asset classes, but that maybe all were tied to variable rate debt. And so they had an entire portfolio that was exposed and people that were wiped out because everything was exposed to the same type of debt. So I think that the asset class and geography, and that's a really important diversification strategy. Also looking at what type of debt is on there. Is it all variable? Can it not be? And how do you space that out? And then how is the value on the property being created? Like, for instance, and I'm not trying to toot our horn, but it's very different than what you're going to get from most multifamily. We're not buying buildings on a cap rate. We buy nasty Kmarts that have been empty for 10 to 12 years. It's called cap rate arbitrage or asset, reallocation. We're converting that to a different asset class, which changes the formula by which it's valued. We take a big box, we chop it up into little boxes, we buy it on a price per square foot. And then that's going to force the value when you convert it to an asset class that is valued by the net operating income divided by the cap rate. But that market still goes up and down and changes things significantly. Storage is still tied to the housing market. The housing market was affected when the interest rate shot up. And even though we don't use variable rate debt on any of our projects, we either pay cash or fixed rate debt. That doesn't mean that we don't have projects that are way behind where they're supposed to be in terms of lease up, because self-storage leased up at 3% occupancy per year for decades, with the exception of 2008 to 2010 and now, right? It's tied to the housing market still. So there's still risk there. I have several projects that are behind schedule. We had one this past year that we exited early. We bought a Kmart building for $2.5 million. We put 3 into it. We're into it for 5.5, and we were going to hold it for 5 years. We let it go in 37 months, but we let it go for 9.53, and we beat our projected investor returns because we had multiple exit strategies. So I think that if your value creation is tied to the rent always going up, that could be challenging depending on what the market gives you and what the timing is. So then you're looking at, okay, maybe the riches are in the niches. You're looking for people that are a GC, that control their fixed overhead costs, maybe that have in-house management, maybe have unique strategies of picking up distressed properties. Like I know, Michael, you've got a history of working with groups that are doing that as well. Like, how do you create a value delta other than just buying it here, get the rents to go up, and it's going to be worth here, and we sell it and we all get a payday, right? How do you create enough value through an asset class reallocation that you can refinance through? You're creating so much forced appreciation that you can cash out that way and hold it long term. There's different ways that you can play the game, but I think that so many people have been stress tested in the last few years. It's actually my personal belief. It's a great time to be shopping for partners. If you are looking around and you're looking for operating partners right now, you can ask, how did things go for you 2022 to 2025? What did you learn? If you're still operating, you either did a lot of things right up front, you controlled your risks, you partnered with the right people, or you adapted and adjusted very, very quickly. But in my mind, that's more of the partner that I'm interested in from a risk standpoint, because that person has been through the fire. So I think that it does create opportunity as well.
And I think that's a really good point. And not only the operators you mentioned, but the ones that fought the fight and are still standing today because they still fought through it. A lot of people gave up. A lot of people just threw their hat in and waved a white flag and said, I'm done. So, I think you bring up a very good point. Go ahead, Michael.
Clint's such a great speaker. I don't have a podcast, but if I did, I'd have him on because he'd take up the whole time. He's got a lot of good info that he's sharing. It's amazing. And I got into this business I was putting money into deals, and I got asked to raise capital. So I raised capital in my first deal, raised $5.5 million in 4 days. And I was like, okay, maybe that's luck. And then we did it. And it just kept repeating itself. I was never supposed to be an asset manager or managing assets, but I brought in so much money into these deals. I am now helping manage them on a day-to-day basis because of that. Because I am here, I have to protect my investors' capital. And that's the number one thing, is always protect investors' capital and protect your tenant who's paying the bills. And then we can protect ourselves later. So that's sort of the way I approach things, is I'm always looking who I can serve, and if I can serve my tenants and serve my investors, I get served later. So I think that's a great thing. And the interest rate run up, yeah, it happened. Nobody was expecting it. But what's happening today? And I understand why people want to put fixed debt in there. So, and I have friends that are all they're going to do today is on a go forward basis is fixed debt. But just remember, floating debt always outperforms fixed. That's been the history, and the history of the world is floating debt always outperforms fixed. And people today that are buying serious assets are putting them on fixed debt. That yes, they're buying an interest rate cap, but interest rates have never been as high as in our lifetime, except maybe back when we were young, when they were 16, 17, 18% when I was in grade school. You know what I mean? But ever since then, they've always been low. And we have an administration in there that loves transactions and loves to get money to move and is a real estate mogul. So I have a feeling when this war slows down or the Strait of Hormuz gets opened up, we're going to start to see a lot of other things open up as well. And why is now a good time? Because we've hit the bottom and the Fed's already started lowering rates. When the Fed actually starts to lower rates, we're already a little bit behind where the bottom of the market has been. So now's a great time. And working with amazing operators, the amazing operators had exits early. They haven't had exits recently, but they're actually operating and still buying. And like the gentleman said, what does Warren Buffett say? When's a good time to buy? Always.
Yeah. Continue
Continue to put money in and diversify. It's called stepping into the market, but you got to keep stepping in. And sooner or later, you're going to, instead of just base hits, you're going to find yourself hitting some home runs. So just keep investing always in all ways, and in different, and pick your asset class and pick the jockey you want to ride, and ride that jockey as long as they're continuing to move forward. If I got in at the wrong time, but I'm still here. I'm still standing. I'm still investing. I'm still buying. So when is a good time to buy? Every single day, when you can find the right opportunity and it pencils the right way.
Hey, I've always said, I've always made money in real estate when there's a Republican in office, when there's a Democrat in office, when interest rates are high, when interest rates are low, when it's snowing outside, when it's raining outside. It makes no difference, right? If you're consistent at it, you can make money at it. So I want to shift a little bit. You guys have commented about, the money that you have raised, from passive investors to deploy in deals. But I want to talk about techniques. So if everybody could just, what's one technique that you use over and over again that helps you, raise capital from passive investors? Clint, why don't we start with you?
I'll use the podcast as an example just because it likely may be an answer that is different from what you guys, the value that I know y'all are going to bring. The first time I raised capital, it was from the cardiologist that I'd been friends with for years and had trust with. I made 15 phone calls, 12 people said yes, and we bought a Kmart building. I was like, oh, this is easy. The reality is, that trust transfers. I'm going into surgery with people, dealing with patients that are trying to die on the table. We've got a very strong relationship. That's why they chose me to be in that position in the first place. So it's a little bit of a cheat code. As you get farther out, you raise more and more capital from larger groups of people. That trust only transfers so far. And then it's going to come down to track record, your ethics, your morality, your communication, your ability to do what you say you're going to do. And exactly what Michael said is you protect the asset first, the investors second, and yourselves third, in that order. And you do things the right way and you communicate when you say you're going to do it. One of the ways that podcasts are used to raise capital is that I know that this year I need to raise $25 million, let's say. It's probably higher than that, but let's say I need to raise $25 million. Am I going to have a podcast that's going to get in front of enough people with my known conversion rate, with my average investment from my pool of investors that we've raised capital from in the past? I have a good idea what my conversion rate is going to be. From everybody I talk to, this percentage of people are going to be interested. And of all those people, this tiny percentage are actually going to end up being investors. And I know my average investment right now is 128 grand, right? So if I look at that conversion rate and this giant population and what the average amount that I need to raise, say, okay, $25 million divided by the average amount that investor puts in gives me a number. And then I have to multiply that number times my conversion rate. And it's going to end up being a number something like 80,000 people that I need to get in front of to raise the 25 or $50 million, whatever the number is. Am I going to build a podcast that's going to reach that many people? Absolutely not. Of course not. But what I can do is learn everything about podcasting and understand that it's a very transactional world and that people are generating and producing content. And it's their job to make sure that they have people that can be well-spoken and provide value and do that. And so what I do is I go out and I found a population of 100,000 active listeners across all different podcasts. A lot of people in the medical world, which is the background that I come from, a lot of people in dental or cardiology or whatever it may be. And when I go ask that person to be on my podcast, 70 to 80% of the time I get an invitation to be on theirs. It's very transactional, and I want to provide value, and they're providing value to my listener base as well. And a lot of my listeners are white coat professionals. So I'm aiming for some of those fringe podcasts where they're not talking about real estate as much, maybe just once or twice a year. You're going to have a better impact with that group of people that maybe don't hear about this because they live their life in the office or at the scrub sink in the hospital. So I use a podcast as a way to get on a platform with other groups. And that's way I know that I can put the plan together to speak in front of 100,000 listeners. And a small percentage of those are going to have interest in what we're doing, and we're going to connect. And a small percentage of those are going to end up investors when and if what we're doing meets the goals and the needs that they have for their family. And the other thing is, don't sell it. It's hard for me to say that because I come from a sales background, but this is education. You want to educate. There's nothing about my deal that makes it a great deal. What makes my deal a great deal is if it fits the needs that you have for your family, and that you've had the conversations with your husband, your wife, your spouse, your partner, whoever it may be. You know where you're going and what you're trying to accomplish, and you work backwards from that to find asset classes, timelines, payouts, and ethics and communication that match up with your goals. That's what's going to make something a great deal, is if it helps you get where you want to go. So there's nothing I can say or should say to push you into a deal or sell you on a deal. I shouldn't even be able to do that. If you're coming and you're like, hey, this sounds like a good idea, and maybe you have questions, my first question is usually going to be, what are you trying to accomplish? What's your goal? Where do you want to go? And if it's not a right fit for you, I will try to be the first one to tell you that it's not the right fit for you and you shouldn't do it. Because at the end of the day, the credibility and the communication and the relationships that you build, just like Matt mentioned, is more important. There's no amount of money that's worth it for us to take it from the wrong investor, because 2 to 3 years later, they're going to be frustrated, and I'm still the one that has to take that phone call. So if the partnership is not going to work, I would rather be the one up front to tell you that. But it also means we're taking people originally that we had very close relationships. That trust only transfers so far. Once you get out to groups where you don't have that, you've got to build that credibility. I think podcasting and targeting those groups are a really good way to put the numbers up and know I can get down to this conversion rate with this dollar amount and hit the goals that we have. But the goal of raising the capital should not be the most important thing. The most important thing should be making sure that you're still able to do it 10 years and 20 years from now, because you're doing it ethically, with the right way, with the right partners, and that the people investing with you then are the people that started investing with you and stuck with you because you did it the right way.
Well spoken, that's for sure. Man, Clint, you're on fire tonight. Holy cow. Michael, why don't we jump to you on that? And I just want to comment, Matthew, he's at the airport. He had to jump on a plane. Matt, travel safely. Hope you get home safe, and we'll look forward to catching up soon, man.
Hey, man, I'm about to take off, but I will say, you can kind of see, like Clint's saying, you can watch what we're all doing, right? You can watch Clint, you can watch Michael, Blair, you can watch me real time. Like, we're making ourselves we're putting ourselves out there. But yes, thank you guys. God bless y'all, Clint. I'm loving it. And also, I think it's also important to always be a student, right? Like, we're up here talking and sharing, but I'm also learning at the same time. And you got to enjoy this business. It's such a beautiful thing. I appreciate the space. I appreciate everyone listening. God bless you guys. And I'm still listening until we take off.
It's awesome, man. Travel safe. And what you said is so true. I spoke at an event last night up near San Francisco, and I spoke, but I learned also from the audience, because they ask questions, right? They get involved, they get engaged, and they ask questions which make you think and help you learn a little bit more. So, Michael, how about you?
So for me, it's all about relationships and understanding what the investor needs. Because what I have isn't always what they need, just like Clint was saying. And when the timing's right with what I have and what they're looking for, they're going to invest. And I was just at a conference last week. They were having one here in Scottsdale. This group was, and a gentleman was like, "Hey, I got this amazing." He goes, "I seen your email. Tell me about your deal." And I'm like, "Do you even know what my name is?" Because I'd never met the guy. And he's like, "Well, yeah, you see your name tag. It's Michael Guthrie." And I go, "Absolutely." I go, "But how do I know you're a right fit for me?" He goes, "What do you mean? I'm here to write a check." And I go, "No." I go, "This is like a 5-year marriage. I'm going to have to answer your calls, respond to your emails, your texts. If you're going to invest with me, you're going to get my cell phone. And I want to make sure this is the right fit for me also, not just because you have money." And great, I'd love to take the money. Don't get me wrong, but I also want to make sure we're compatible, and you might even pass my barbecue test. Because if you don't pass the barbecue test, where I'd actually invite you to my place to have a barbecue, maybe this isn't the right fit for both of us. And it's not just about money; it's about relationships. And if I don't understand what your need is, or why you really want in this investment, is it just to make money, or is it you're looking to replace income or protect your family? What is this about for you? If I don't understand that, I don't want your money, because I want to know more about you. And my lowest check writer, I have one, and I have one investment from that check writer. My lowest is a 50,000. And it's great that Clint knew his average investor is 128. My coach years ago had me figured out mine's right around 170-ish. But you want to know what keeps that person up at night, and that I'm not taking their last dollars either. And that my $50,000 investor is my 35-year-old daughter. That's my only $50,000 investor. So to understand what somebody's need is and what they're looking for, you're going to create a relationship around that. And once that relationship's created, you're not going to get those $50,000 checks. You're going to get $100,000 plus checks on the regular basis. I have a group of folks that I met when I was in the Tony Robbins Platinum Partnership, and every single deal at a minimum, he writes 100,000 and she writes 100, and sometimes it's 200 for each of them on every single deal we place in front of them. They don't even read the deck. They just want the link to the portal because of the trust. And they know we're in deals that we bought in 21, 22, and into 23 that are having some difficulties. And they know that because we respond, we send out newsletters on a monthly basis. It's even more important to communicate when things aren't going well, so everybody's aware.
Yeah.
So communication is always key, and relationships are paramount.
Yeah. And we're going to get into transparency here in a minute. So I appreciate you kind of, starting to grease that highway. So go ahead, Blair. How about you? What works best for you in building that new relationship and the trust of an investor to invest in whether it's student housing or multifamily?
So for me, since I work in residential real estate, a lot of my deal flows naturally. Some of my clients are from the referral program I mentioned about, the law firm that I partner with, where their first step after getting their citizenship is buying their primary residence in America. So I will be the one that's guiding them in terms of what they need. Is this for their retirement home? Is this for their kids, for the school? Then afterwards, the natural conversation comes, okay, we still have a certain amount of money that's liquid. Do you have any good project you can recommend? So again, because of that relationship from even guiding them through their primary home purchase, I kind of have a good understanding of their family story. I will give them different options. If they are more hands-on, they want to have a physical asset that's close to where they live, then great, we'll find a single family or even like a duplex apartment or something like that in the local area where they can manage themselves. But for a lot of the clients, if they are really busy professionals where they don't have the time to managing their own, rental properties, that's where the conversation of maybe investing in a multifamily comes in. Or there are some other clients where they have, after the money they invest in their primary home, they might have some leftover, but it's not quite enough to put down the down payment, the closing costs, maintaining another rental property here in Southern California because the price is really high, then that's where I can be, just like Clint said, based on what they need and what's her financial situation, I can bring up, hey, by the way, right now I do have another channel of investing, which is more passive than if you only a rental property and the minimal buy-in is only 50,000 instead of for a $600,000 rental property, 20% down, that's 120,000. Would you be interested? So some of the clients will also take that opportunity to look into a more lower investment threshold project. So yeah, like at the end of the day, it's really about getting to know them and knowing their family, what's their needs, what's their short-term goal, what's their long-term goal. And because I continue nurturing that relationship, I delivered on previous promises from searching their primary home or sometimes even helping them finding a rental property if that's truly what they want and they need and able to do. Then when they have that extra liquid capital, that's where I just, mentioning to them, saying, I have this great opportunity. If you're interested, we can talk about more so that we can see if this one makes sense for you. But yeah, it all comes down to communication as well as delivering on previous commitment so that way they feel more comfortable moving forward with you.
Awesome. Thanks for that. That was really a great outline of that. So appreciate that. Hey, as we start to land this plane here tonight, I can't believe that we've blown through an hour already, right? I want to kind of end on this note, and that being, you know, uh, take the operation side out of it. So, Clint, don't talk about self-storage operations. Michael, don't talk about multifamily operations. Let's take the operations out of it and just solely, from your perspective of being a good steward for your investor who's trusting you and investing in real estate with you today, no matter the asset class, what's the risk and what's your transparency like with that investor? What's your communication with them after they make that investment? And Michael, why don't we start with you?
We like to send out monthly newsletters in regards to the properties that they're in, and we also send out educational pieces on the off weeks to our investor pool all the time. Because the last thing I want to do, and so then they know what's happening at their asset. That's why we talk about that's why we send them out monthly newsletters in regards to their asset, how it's performing. So they actually see the numbers. This is what we bought it for. This is the loan maturity date. And then it's got basic rent roll. Did we go up in collections from last month? What's our delinquency? And those sorts of numbers. Those we're dispensing in an email to our clients on a monthly basis, and we run them through our CRM so we can actually tell if they've actually opened the email. So if somebody calls back and says, "I've never received any of your emails," I can go to the CRM, look up their account, and I go, "Well, you received this one on this date, this date, this date, this date. You may want to check your spam," or I can have them resent. Or if they've opened them, you can go, "Well, you opened last month's on this date, you opened the month before that on this date," and you can actually just screenshot that and share it back with them so then they understand we are communicating on a regular basis. Because I don't want anybody to wake up in the morning and go, that apartment complex or something went bankrupt and they had no idea this was coming.
Right.
If that was the case, that I had to tell them.
Right. Blair, how about you?
So for me, same thing like Michael said, communication is very important, especially with a lot of my clients. They are natural transition from just a home buyers, coming to become a new citizen of this country, and then doesn't even know the, local area where I help them, sometimes even setting a bank account or recommend like schools for their children. So a lot of those clients become my family. So the last thing I want is for them to feel like they're not in the know. So if say the UC Berkeley student housing project, it's same thing where they bought the student housing, they start renovating it. So for me, I will give them monthly update from the program. Also, I like to pick up the phone, just check in with them, say how they're doing, how their kids doing, and then also give them a personalized update just so that I am keeping an eye on their asset instead of, just let them feel like they're in the dark, there is nothing. I always call my clients. If it's not once a month, sometimes it's every 6 weeks, especially those clients that I have helped them purchase large, real estate. I always want them to be in the low know. And then I personally do quarterly events. Sometimes I do neighborhood kind of get together. Other times I do lunch and learn. Other times I host events based on a holiday so that I can have all my clients in the same room so that they can also talk to each other. So if they all in the same program, they can talk to each other. So there is reassurance from each other instead of the only source of communication is from me. And obviously I will be face to face with them. And if they have any question, that's the best way to address it. A lot of times face to face. So I try to do those events at least 4 times a year, in addition to the phone call, as well as the CRM monthly newsletter update.
Awesome. Thanks, Blair. How about you, Clint?
Blair, I love that answer of getting people together. I think that is really powerful because sometimes, people just don't want to hear it from you anymore. Sometimes they want to hear it from other people who are in the deal. And I think that continuity that you can create and community that you can give that is so powerful that sometimes you just need to get other people's perspective. I love how we started talking about risk here, and the two of you both went towards communication and education. I love that. I think that you have to look at risk. There's two different sides of the coin for me because the projects that we're doing are so heavy on the development side. One of my partners, Eric, said something that stuck with me when we first partnered together is that risk is a muscle, right? The more you work that muscle, the stronger it gets and the more you're willing to take on. But you got to work that muscle. You can't just go in and squat 400 pounds the first time, right? It's a muscle and you got to work on it. For our types of projects, I think you have to look at controlling the risks in two different ways. Number one is exit strategy. Where's the value coming from that you're creating? The types of projects that we're looking at is we're buying nasty old vacant buildings that nobody wants. We want the ugly ducklings we can turn into golden geese, right? I want the homeless people in it. I want the hole in the roof from the AC unit that got dropped on it by a tornado. We want the worse it is, the cheaper we can get it, right? And we can convert that into climate controlled storage. Now that's very, very challenging, but we're unlimited licensed GCs. My partner's been doing construction since the 90s. And the reality is it costs us about $65 to $70 per square foot at the day that we get certificate of occupancy to have one of our facilities converted into climate controlled storage. And that's the building, the land, the parking lot, all of it. Now, we mitigate risks in several different ways. The bank actually looks at the construction as the riskiest part of the whole deal. That's not that much risk for us. One of our most recent deals in terms of the appraisals we got back is we're all in on the deal for $7 million during construction, and at certificate of occupancy, the bank appraised it as an empty facility for $11.3 million and said if we don't change any rates, the stabilized value is 13.4. That the forced appreciation from swinging the hammer is what the bank looks at as the biggest risk. It took us 10 months. In our opinion, the biggest risk is actually the lease up. Like, how are we going to make sure that this thing leases up and is not affected by the housing rate or anything else over the next few years? But if we've created enough value up front, we have multiple exit strategies. Multiple exit strategy can be, we could do a cash out refinance at 65% LTV, pay out all the investors their return of capital plus their return, which would mean it's not a capital gain because we didn't sell anything. And then we could just hold it long term if we needed to. Or we could sell the property at certificate of occupancy, at stabilization, or anywhere in between, because we're essentially half the price of new ground up development. So for us, we're very, very heavy on the development side. And so the risk mitigation comes from a half priced asset from the beginning. And that's kind of our, we have a bulletproof basis is what we say in-house. And it's obviously a little bit flippant. But the basis is significantly less than the replacement cost. Because it would cost us, the first Kmart building that we bought for $1.5 million was 87,500 square feet in Reidsville, North Carolina. At the time, it would have cost us $6 million just to build that cinder block shell. And 2 years later, with the cost of materials, it would have cost $8 million. So that rock solid basis for us creates a lot of risk mitigation. We're doing in-house construction at cost plus 12%. We're fully vertically integrated. We're finding off-market deals. We're raising the capital. We're doing the construction. We're doing the property management. So that's one side of the coin. But what Michael and Blair are talking about is the other side of the coin that is just as important. And that is managing the risk throughout the life cycle of the deal by making good and wise decisions and being a steward of the money, protecting the asset first, the investors second, yourselves third, in that order, and communicating, making sure that you're over the top about what's happening. I have one of our investors in our deals tragically lost capital with two other multifamily operators that had projects that were a total loss. And out of that situation, as it was happening with both of them, we were talking through the whole process because we got a friendship, we become friends. And out of that scenario, he ended up with one investor that he said he will never invest with again because they went dark, social media went away, and didn't like their strategy, their plan, or their communication. The other group, things went bad, but he said that's the only group with he'll continue to invest with because he knew what was happening. They had a plan, things went bad, and they created a pathway to get him into other future deals at the GP level to help him recoup that. And there was a plan. Hey, this is what's happening. This is why it's happening in 2022, 2023. This is what we're seeing. We're going to step up our communication. We're going to communicate with you more and let you know exactly what's happening. You know what? We're going to need to exit this deal. It's not going to be pretty, but this is what we're going to do to make sure that we're creating a pathway for our partners to get whole in the future. And I think that communication gave him a lot of peace, even though things weren't going well, when he was in the exact situation with another group that was giving him a lot of turmoil. And so I think that within the fundamentals of any deal, there's always risk, and you have to be comfortable with that. But you have to look at how do you control the controllables? How much of it is controllable and how much of it is just not? And on the part that's not, how good are you doing of keeping your word and educating your investors and making sure that they remember that you're all in this together and that you get paid after they do? And leaning into it that way. I would say risk is a muscle. Control the controllables, look for the riches and the niches and your ability to control fixed overhead cost or asset class conversion or cap rate arbitrage to create value in ways that are not just dependent on the market continuing to always go up. But just like Blair said, just like Michael said, at the end of the day, this too shall pass. And what's going to matter is how you came out of it on the backside in terms of creating trust and ownership, extreme ownership and responsibility for what's happening in the deals and making sure that you're communicating with the investors, even though sometimes that means that you just have to stick your face in the fan.
Yeah, 100%. And, I kind of want to end on this. We've all had investors that we've raised money from. We've raised millions of dollars between us. We've had deals that have been very successful. We've had some deals that have not been as successful. And we've all had those investors that we wish we would have said no to. And I really want people to remember, if you're a capital raiser, and there's somebody that you have that feeling about, don't be afraid to say no. It's okay to say no. And it took me a long time to be able to realize that. So if you're a passive investor, please don't take that personally. But if you're an active operator and you have somebody like that in your life, because sometimes the little investor, just because you need some capital, isn't worth having in the deal. So, hey, I want to thank you guys for being here. I'm really honored. I wish Matthew could have stayed the whole time, but his flight got delayed in that. And Blair, thank you for being here. Michael, thank you for being here. Clint, appreciate you guys. Why don't you tell people how they can get a hold of you and your best mode of communication? Go ahead, Blair.
So for me, if you have any additional questions, you can email me at buywithblair1011@gmail.com.
I love that email address. Buy with Blair.
Yeah.
Go ahead, Michael.
So I've dropped my contact information into the chat, michael@wealthmissiongroup.com. My cell phone number, I'm in Scottsdale, Arizona. If anybody's near here, want to get together for coffee, and we can communicate any way you want. That's my cell phone and that's my email.
Yeah. Clint.
Yeah, same. I just put my cell phone and email in the chat. I'm happy to connect with anybody about anything that I can help with. At the end of the day, I know a whole lot about very, very little. If it aligns with what you're looking for, storage, raising capital, Airbnb, or anything else, I'm happy to contribute any way that I can.
Awesome. Hey,
Also, I want to drop my Instagram on the chat as well. So I do have an Instagram, mostly a residential property tours and the real estate terminologies. But as I'm more involved in the multifamily space, I'm probably going to host more talks on Instagram. So I'll drop my Instagram handle there. It's also by with Blair 1011, but I'll drop in the chat. Thank you.
we should do an Instagram live, Blair. Hey,
Yeah, sounds good.
and I know there were a couple of questions that got left in the chat. I apologize for that. We're out of time, but if those questions were meant specifically for somebody, reach out to that person, or you can reach out to me, and I'd be more than happy to help try and get that question answered for you. Thanks everybody for being here tonight. Appreciate all the guests, the panelists. I know we all have events and things we're going to tonight, so good luck. And I'll look forward to catching up with everybody soon.
Thank you. Thank you, Mike.
Thank you.
Thank you,
Mike.
everyone.
Appreciate you having us.
Great panel.
Most people think wealth comes from working harder. It actually doesn't. It comes from positioning capital where it works harder than you do. The problem is most investors are still playing the wrong game. They chase trends, they follow the noise, they invest without a clear framework, and they call it strategy. It's not. Passive investing isn't about being passive. It's about being precise, knowing what to look for, what to avoid, and when to act. Because in today's market, returns don't come from luck. They come from disciplined decisions, strong operators, and understanding the risks before you ever wire capital. That's exactly why we're bringing together investors who have been through multiple cycles, not to pitch deals, not to raise capital, but to break down how this actually works, what matters most, and what doesn't matter, and how to think differently than most investors. Who's building long-term wealth, not chasing short-term wins? If you're serious about putting your capital to work the right way, this is where it starts. This conversation. Smart Money Moves unlocks the next wealth wave of passive investing. So join us for the conversation.